Hey folks, it's 12:30 New York time, 9:30 my time, whatever time it is for you. So it's time to get started. People are still joining in, but gives me a chance to do my lead in. The first is a reminder that your first quiz is a week from today. It's next Monday. If you haven't been checking your emails, I did send you an email on Saturday with the details about the quiz. It'll cover pretty much everything we do through Wednesday. So what slide that'll be 180 something. Um, but it is going to cover everything through Wednesday's session. It is a 1 hour quiz. It is online. It'll be accessible for about 9 hours that day. So you can decide what the best time for you to take it is and just take it. So it won't be at class time. I want to emphasize that it will be actually spread out, so that you're not locked into doing it at this time. In fact, we will have class next week, even though there's a quiz, but it'll be a 1 hour class rather than a 1.5 hour class. I'm trying to mirror what I would do in a regular classroom. In a regular classroom, we take the quiz in the first 30 minutes and teach the rest of the class. You'll be doing it online. It's open book, open notes, open laptops. You don't have to memorize any equations and formula because that's not the objective. So keep that in the back burner, something to work on, and I'll send you more stuff, more reminders as we go through the week. Any questions before we start? No. I'm looking at your Google shared spreadsheet. Looks like pretty much everybody. There are a few names with no companies next to them, but I'll assume that that's just an oversight. Or you might have dropped the class. I don't know. But because this is a list that I got in the first week of class, I downloaded it. So if you've left the class since, then obviously your name's still there. But it looks like almost all of you picked a company, which is good. And from your emails over the course of the last week, it's clear that you're also working on the project because the questions relate to the project. So that's good too. But today we're going to talk about the next phase, which is talking about betas, where do they come from, and kind of debunking this common mythology that betas come from regressions, or worse, that betas come from Bloomberg or Bara or some other service. So if you remember last session, we were talking about the beta regression. If you look at any textbook, it says regress returns on the stock against returns in a market index. And it just moves on. But we talked about the choices you have to make. When you talk about running a regression, you've got to decide how far back you go, 2 years, 5 years, 10 years, 30 years. Whether you use daily, weekly, monthly returns. What index do you use? How do you compute returns? So what I'd like to do today is start the session off by talking about how I ran my beta regression for Disney. And I'm going to do something very insidious. I'm going to run the regression, take it apart, and then at the very end of the process, I'm going to talk about why I don't trust regression betas, why I think it's a terrible way of thinking about betas. But let's lay the foundations first. So this was in 2013. I wanted to run a regression for Disney. I went back, and here are the choices I made, and I'll back up each one of them. I decided to go back 5 years. Why not 30 years? Because as I said, going back 30 years gives me more data, but it gives me a company very different from the company I'm looking at in November of 2013. Disney has changed. I went back 5 years. And I mentioned most services go back 2 to 5 years. In fact, if you've had a chance to get on Bloomberg and you print off their beta page, their default is 2 years. I'm going back 5 years. Because I go back 5 years, I get a luxury of looking at monthly returns. If I went back only 2 years, I can't do monthly returns because there are only 24 months of data. That's not enough for a regression. But with 5 years, I can get about 60 months of data. So I went back 5 years. I decided to use monthly data. Why monthly over weekly? Again, I think you get slightly better regression numbers with monthly returns than weekly returns because you get less noise. Daily, as I said, is off the table. It's too noisy. Weekly or monthly, I went with monthly. 5 years or monthly. And then I computed the returns every month for Disney. So let me go through the mechanics of what this actually means. When you buy Disney shares at the start of November, let's say you bought it on November 31st or December 1st of 2009, the open, you'd have paid $30.22 per share. I wait till the end of the month, and at the end of the month, the stock was at $32.25. So during that month, Disney shares went up $2.03 per share. That's your return, right? Hey, not so fast, because when you buy shares in a stock, if there is a dividend that is paid during the month, you're saying, how would I know? Your stock has an X next to it. It's called X dividend. That's the day in which ownership passes. And in December, you would have received 35 cents in dividends somewhere in the middle of the month. So if you look at your total returns, in addition to the $2.03 you got from price appreciation, you'd have also got 35 cents in dividends. So that's $2.38. To convert into a return, I divide by the price at the start of the month. That's always true in returns. You look at what you paid, you look at your price change, you look at the dividends, and you get the percentage change. Disney had a pretty good month, a really good month in November. It was up. The returns you'd have earned would have been about 7.88%. And I do this every month for 60 months. Sounds tedious, but in an Excel spreadsheet, it's pretty simple, right? You download the prices, you download the months in which the dividends get paid, and you compute the returns every month. If you have access to Yahoo Finance, Dan Martin, I think, did it in the class. Dan, how long did it take you to get the data on Yahoo Finance for your stock?
Not long. It's in historical data.
You can download as an Excel spreadsheet, copy it, write down the spreadsheet. You've got 60 months of prices. In fact, in Yahoo Finance, it also gives you the dividends, in which month you can put the dividends in the months. You get the returns every month. I'm almost there. One final choice I had to make. I had to pick an index, and I decided to go the conventional route. Most services in the US use the S&P 500. Doesn't make it a perfect index, but I wanted to see what the S&P 500 would give me. And I computed the returns on the S&P 500 every month. Now, what does that involve? It involves looking at the change in the index from month to month, just like on the case of Disney. But in the case of the S&P 500, you also get dividends on all of the companies in the index, which means you get it almost every month. There is some dividend coming from somebody, so I added that dividend on. I got the returns on the S&P 500 every month for 60 months. So think of this as an Excel spreadsheet. I've got returns on Disney by looking at the price change and the dividends, returns on the S&P 500. I ran a regression. How easily that rolls off. I mean, 40 years ago, to run a regression, you know what I'd have had to do? I'd have had to create these columns. So I computed all these additional numbers to come up with a regression. You should be glad you live in a time where if you have Excel and you go to the tool pack, you can run a regression between any two columns. So here's what my regression looks like for Disney. See those blue points? Basically, this is called a scatter plot. And often when you run a regression, this is the place to start your regression because it gives you a picture of what your stock did relative to the market. It's called a scatter plot because on one axis, the y-axis, you have returns on your stock. On the x-axis, you have returns on a market index. You know what those blue points are? Every month of data you plot. So let's say in November of 2008, the returns on Disney were about 8%. The returns on the market were about 2%. You plot that point. You plot 59 points. Now what happened? I thought we had 60 months of data. What happened? Why did I end up with only 59 in my regression? I have 60 months of prices. But remember, to get a return, I need a price change. So in the first month, I don't have a return. I have to wait till the second month. So 60 months of price data become 59 months of returns. So if you want to count, and you're one of those people who's a type A personality, you don't believe me, you can count the blue dots. There should be 59 blue dots here. Then I find the best fit line. Sounds fancy, right? Best fit line, I must be looking at the points here, which is, you know, in statistics, how when you run a regression, it's actually fitting a line through these points, a best fit line. Does anybody remember your statistics enough to tell me what the basis is for that fit? How does the statistics package that you use, whether it's Excel or R or whatever, how does the statistics package decide what the best fit line is? Robert Peterson, do you have an idea of how is it?
I think it estimates the least squares.
It estimates the least squares of the distances. In fact, the Greeks who fit the first regressions actually sat there with a ruler. Think about how tedious this was, measuring how far the line fell from to figure out what the best, thank God we don't have to do that. Excel does it for you. Stats packages do it for you. Don't reinvent the wheel. You don't have to learn how to do a regression from scratch. It's not a marketable skill, but that's a best fit line. See the line drawing? That's your best fit line. And when the regression fits a best fit line, it also spits out output. And it spits out dozens of pieces of output, but I'm going to focus on 3 very specific pieces of output that I'm going to zero in on. First, it gives me an intercept for the regression. See the point at which it crosses the x-axis, the line? That's called your intercept. I'm going to argue that that intercept for Disney is going to tell me something about whether Disney was a good investment during the 5 years of the regression. Keyword is was. I'm not telling you whether it will be, but whether it was. The intercept from this regression was 0.0071. Now, decimals and percentages, you got to remember 0.0071 is 0.71%. So the intercept is 0.71%. You're saying, is that good? Is that bad? We'll come back to that, but that is the intercept. The slope of the line is 1.2517. You know what that tells me? If I trust my finance textbooks, that is my beta for Disney, 1.25. The R squared for the regression is about 73%. That tells me that 73% of the variation in Disney returns during this period came from what the market did. File that away, because there is an economic rationale we're going to tie to that number, 73%. So I've got the intercept, the slope, and the R squared. You're saying, what are these numbers in brackets below? If you're in a statistics class, you're forced to report those, right? Those are your standard errors. They tell the world how uncertain you are about your numbers. The standard error in the intercept, the standard error in the beta. So I get intercept, slope, R squared, and I get standard errors. I'm going to use that output to kind of get a first feel for Disney. The way I think about regression betas is they're like that. You go into a new doctor and they're on this panel of tests, you know, your blood test, your blood pressure, because the doctor wants to get a sense of, hey, where do you stand in terms of health? A regression beta is very much like it. It's not a deep look at the company, but it's your first look at this company. So let's take this regression apart and see what it tells us about Disney as a company. Let's start with the intercept. The intercept was 0.71%. So again, 0.0071 in the regression is, I'm taking it, so in percentage terms is 0.71%. I want to use that number to get a sense of, was Disney a good investment during the 5 years of this regression? So here's what I'm going to do. I'm going to go back to my risk and return model and ask, what would my intercept have been if Disney had done exactly as predicted during the regression? So that's a risk-free rate times 1 minus beta, if you remember last session. That is what my stock should have done. In the case of Disney, if I can compute that risk-free rate times 1 minus beta, I'll get a sense of what Disney should have done, and then I could look at what it actually did and take the difference. And here you got to deal with a few mechanical details. My regression was run using monthly returns, if you remember. That was the choice I made. My risk-free rate then has to be a monthly risk-free rate. What would I have earned on a monthly basis over the last 5 years? Monthly rates are short-term rates. So I went and looked at the monthly T-bill rate every month for those 5 years. It wasn't much, it was 0.5%. But that's an annualized rate. All treasury rates are stated in annualized terms. So for a whole year, I'm demanding 0.5%. But I want something on a monthly basis. I take the 0.5% and divide by 12. It's a shortcut, just do it. It's not going to make a heck of a difference if you did this with a compounding equation. So basically, I'm getting a risk-free rate on a monthly basis, which looks tiny. It should, because it's a monthly risk-free rate. It's 0.042%. My beta is 1.25. It came from the regression. If I multiply 0.042% by 1 minus the beta, I know this is sounding incredibly abstract, but hang in there. I come up with minus 0.01%. Let me pause right there. You know what that minus 0.01% is? If Disney had done exactly as predicted during these 5 years based on the CAPM, the intercept should have been minus 0.01%. What is the actual intercept? Plus 0.71%. You take the difference between those two numbers, 0.71 minus of minus 0.01, I get 0.72%. Hang in there. During the 5 years of the regression, Disney did 0.72% better than expected on a monthly basis. You're still not impressed. 0.72%, who cares? 0.72% a month, if you earn that every month, translates into a compounded return of about 9% a year. And here I've got to be careful. 0.72% a month. Remember, money earns money. So you can't just take 0.72 times 12. You could if you're in a hurry, but that'll give you like 8.5%, but that misses the compounding. If you factor in the compounding, Disney did 9% a year better than expected during the period of the regression. I know these layers of abstraction. You're saying, what the heck does that even mean? Let me make this very simple. Let's assume that during the last 5 years, the market was up 20% a year. Let's say the risk-free rate is close to 0. And your beta is 1.25. If the market was up 20% a year for the last 5 years, and your stock did exactly as predicted, remember the beta is 1.25. Sarah Hunky, I'm going to put you on the spot. Did I get your last name right?
Hunky, yeah, you got it.
Okay. You look very relaxed, so I'm going to put you on the spot because you probably can help. I'll help you a lot. So the market is up 20% a year. The beta is 1.25. If your stock did exactly as predicted, what return should it have made?
20%.
But remember the beta,
Or
that's
20%
the beta one.
plus another, plus 25%
plus another 5%.
20%.
So basically it should have made 25%. So if this stock had made 25%, it would have done exactly as expected. With the Jensen's alpha of 9.02%, you know what the stock did? It made 25% plus 9.02%. It made more than you expected to. Why? Because the company had good movies, Avengers did better than expected, the theme parks came back faster, whatever the reason, this stock did better than expected. Jensen's alpha measures how your stock did after adjusting for risk and after adjusting for market performance. That's how I did this for every stock in the market. I computed the Jensen's alpha, starting with A all the way through Z. Nate Smith, if I computed the Jensen's alpha for every stock in the market, and I averaged out those Jensen's alphas, what should the average Jensen's alpha be across all stocks?
It should be 1, right?
The beta should be 1.
Oh, the beta,
Remember,
yeah. Alpha should be 0.
It should be 0. Stocks can't collectively beat themselves. Do you see how absurd it would be if I said, hey, stock collectively had a Jensen's alpha of 7%. How the heck do stocks beat themselves by 7%? So here's, I think, an unpleasant reality. If Disney has a Jensen's alpha of 9.02%, there must be another stock out there with a Jensen's alpha of minus 9%, right? The reason I bring that up is people often complain that their Jensen's alpha is really small. I made only 1%. And I tell them, be glad or you're on the right side of 0. Because if you look at Jensen's alphas across all stocks, for stocks that do well, there are stocks that do badly. And this is my medication against investment regret. How many of you say, I wish I'd bought Tesla a year ago? I mean, I sold Tesla a year ago. Can you imagine if I sat there and said, oh my God, I sold Tesla at 180, it's now at 700. You know what the Jensen's alpha of Tesla is going to be, right? Over the last year, it's only like plus 400%. And part of me is saying, I wish I'd held on to it. But you know what my remedy for that is? For every Tesla with a plus 400%, there's got to be another disaster of a stock, a Titanic of a stock, which has a Jensen's alpha of minus 99.99%. So while I'm sitting there saying, I wish I'd held Tesla, I also tell myself, thank God I didn't hold the anti-Tesla, which is out there with a minus 99%. Now do you see how this can then become a measure of whether you're active money manager? That hedge fund guy, so you decide to put your money with Gabe Plotkin at Melvin Capital because he thinks he's been beaten up and say, I've got to send him some of my money. Now do you see how you can use Jensen's alpha to measure the overall performance of an active? If you tell me you're a money manager and you want to manage my money, what are you promising me in terms of, you might not talk in terms of Jensen's alpha, but what are you promising me in terms of Jensen's alpha going forward? What are you telling me you can deliver? Michael? If you're my active money manager and you say, look, I'll manage your money for you for X% of your wealth, what are you promising me in terms of Jensen's alpha?
To deliver higher else.
So positive alpha, right?
At least than the fee. Yeah.
If you ever talk to active money managers, they'll say in search of alpha. If you're wondering what the heck are you talking about, why do you keep throwing the Greek alphabet in there? Alpha now becomes your reason for existence, because if you don't have a positive alpha, then why would I pay you 2% of my money? Because I can make 0 alpha without even trying. Vamsi, what would I need to do to get a 0 alpha without even trying? Let's say I have money to invest and I want a 0 alpha without even trying. I can match the market. What would I need to do?
Just sell.
Selling will then mean you just have cash, right? You can end up with I guess you can, but there's actually a very simple way in which you can match the market. Liz, John, what could I do?
I mean, you could buy an ETF or index fund.
Or an index fund,
Yeah.
right? Vanguard cost me absolutely nothing to buy the index fund. I can get an alpha of 0 without trying, with absolutely no costs. So you better be promising me alpha greater than 0 if you're asking me for 1% of my money. And if you're asking me for 2 and 20, do you know how much of an alpha you'd have to deliver to be able to? You'd have to deliver an alpha of about 3 to 4%. I think it's insane for anybody to invest in any hedge fund. I know this is a very strong statement. It is insane, because not only will the hedge fund have to beat the market, it'll have to beat it by about 4 to 5% for you to break even. Forget about making money. It's insane. But why do people keep doing it? Well, that's a definition of insanity, right? You keep doing the same thing over and over, expecting a different outcome. But Jensen's alpha basically measures performance. Any questions about Jensen's alpha? So the average alpha across all stocks should be roughly 0. So when I look at a company and I find a company, Julie, I'll be within a minute. If I find a company with a positive Jensen's alpha, I'm already on the right side of 0. Forget about now being just happy. I'm celebrating. This is good. Julie, you have a question?
So just why Disney was so highly correlated with the market, and does Jensen's alpha work better with companies that are more consistently correlated with the market?
Well, first at the company level, it doesn't, the correlation matters. I'll tell you why the correlation matters. Remember those things, the numbers in brackets you saw below the intercept, those were standard errors. So when your R squareds are low, the standard error is larger. So from a statistical perspective, if you tell me you have a Jensen's alpha of 9%, you have a high R squared, I feel more confident about the 9% than if you have a low R squared, because it's a bigger range. So that's the way to think about it. It's a continuum. The more the R squared, the more comfortable I feel with the numbers. But if you're looking at a portfolio, this takes care of itself, right? Because if I have 50 stocks, then the same law of large numbers kicks in. So when I look at mutual funds, I worry less about R squared. But an individual company, that low R squared can be a sign of be careful about how you read the alpha, because there's going to be a range around that intercept. So looking at Disney in November of 2013, their Jensen's alpha is 9%. So I'm going to play the role of Bob Iger. And you're going to be my shareholders in a meeting. And I'm going to get a little greedy. I'm going to come to you and say, look, guys, I did a really good job for you over the last 5 years. You hired me to replace that loser, Michael Eisner. I've done so much better. Look at my Jensen's alpha. It's 9%. I would like a bonus of 50 million. And I've got a board that will push this through. So the question I'm asking, can the management of Disney claim credit for this positive Jensen's alpha? Or is there something else you'd have to check before you decide that it was my hard work that delivered this Jensen's alpha. Shruti, what do you think?
So, I'm sorry, I actually completely missed the question.
Well, my Jensen's alpha is positive. I did much better than the market. So I'm claiming that this is all because of my good management, my decisions. Before you accept my sales pitch, what would you need to check?
I would want to check your historical returns and to see if that's actually.
Well, in this case, the historical returns are actually very good. So I'm saying I did it. I delivered these returns. And part of it is true, right? I ran the company during this period. I've done much better than the market. So do you think I'm entitled to the upside here that it was my job that delivered this?
Taking a little bit of a gander from the chat, I would say you actually have to look at the competitor performance too to see.
And tell me why. Tell me why. Why does it matter that my pure, let's say the entire entertainment sector was up 15%. Why would you be a little more cautious about rewarding me?
Well, because it seems as if it's the performance of the individual companies as opposed to your management abilities.
In other words, something good happened in entertainment. The rising tide pushed me up. I mean, I'll give you an example, a counterexample. If you ran an oil company and you came to me with a Jensen's alpha of -5% for 2020, I'm going to give you a bonus. You know why? Oil companies were decimated in 2020. Oil price were down 30%. And the fact that you kept your Jensen's alpha at -5% means that you did something good. So when you look at Jensen's alpha for your company, as you will, you might want to compare it to the Jensen's alpha for the entire sector. You see, how the heck am I going to get that? If you go to my website, I actually have Jensen's alphas by sector, broken down for US companies, global companies, emerging market companies. The reason I have that average is when I compute the alpha for a company, it gives me something to compare it to. Either a big positive number or a big negative number. It's a good starting point, but I need to make sure that it wasn't some sector-wide effect that drove this rather than your work. And actually, it's something that companies should take into account when they because a lot of companies tie management compensation to how well the stock price does. You know how I would modify this, given that what we just talked about? Rather than tie your compensation to how the stock price does, maybe I should tie your compensation to how your stock price does relative to the peer group stock price, because the fact that you're doing well when everybody in your peer group is doing well might mean that you're just an average manager or even a below average manager who's just coasting along because the sector is doing well. Any questions on Jensen's alpha? Ryan?
Yes, thank you. Back to the comments about active money managers. Let's say that you're an investor and you want to hedge any sort of capital loss factors, and you believe that having short positions might help that. Is your argument that managers still need to beat the market by 4 or 5% still applicable to that investor's concerns and maybe their investment thesis?
You don't want a portfolio manager. You want a tax lawyer. If I go to pay money, I'm saying find a good tax lawyer, because this has nothing to do with picking stocks. This has really got to do with, you got a tax problem. You got to make that tax problem lower. So I don't need to pay a hedge fund 220 to do this. I would actually pay a tax lawyer to give me direct advice. I mean, I've got to make sure the tax lawyer is not taking me to the cleaners. So I don't think this has anything to do with investing. I would still argue the same principles apply, right? Because I want to find something. So I want somebody who can then say, these are the kinds of investments. And then I can go pick an index fund or a hedge fund or an ETF that does deliver those kinds of profits. So all I need is some guidance on tax law for that to work. Not so much guidance on investing. In fact, you know, the rule on tax-driven investing is in the long term, you almost always lose. Right? You look back in history, investing that's driven primarily by taxes is like driving a car towards a cliff. The question is when you drive off the cliff, not whether you drive off the cliff. Kushal?
So can you use Jensen's alpha to predict?
That's a good question, because then let me ask you a question. Tesla's is up about 800% over the last year. Let's say GM is down 20% over the last year. So those are facts. That's from last year. Now you have neither stock in your portfolio. Which would you rather have in your portfolio now? That's really the question it boils down to, right? And I'll give you the evidence. Over time, the correlation between past and future returns is very, very low, very low. But whatever correlation there is negative correlation, which means that if there's a predictive power, it's in buying negative alpha stocks, not in buying positive alpha stocks, because those stocks have been beaten up. And this is a pure behavioral issue. It's a question of whether markets overreact. But I would never have an investing strategy based entirely on past alpha, because that's pure momentum strategies, right? Because that's basically what you're doing. You're either doing pure momentum or pure reversal, but that doesn't mean people don't do it. 90% of investors, that's all they look at. They might not use a Jensen's alpha, but they're using price strength or relative price, which is the same thing almost as ranking companies based on alpha. Carlos?
Yes, going back to the Jensen's alpha, comparing to the sector performance. Let's say in our example with Disney's 7.2% and the industry's 6%. Like, does that give you enough confidence to say Disney's still beating it, even if it's marginally? Or is there a level of significance there?
Remember that standard error that was below the intercept? If you go back a couple of pages, I could show you. See the standard error 0.0053? That's 0.53% a month is the standard error. If you convert it. So we're talking about a range of probably plus or minus 3% on your Jensen's alpha, which effectively means your true Jensen's alpha, if you're at 9%, could be as low as 6 or as high as 12. And that ties to the earlier point Julie made about the R squareds. Even with the 73% R squared, you can see there's a range on your alpha, which means you got to view this with caution. You're not going to fire a CEO after 1 year of negative Jensen's alpha of minus 7%. Right? Because you could very easily have been close to zero and you just caught standard error. But if you have 4 consecutive years of minus 15% Jensen's alphas, you're now moving well beyond the step. So what you do is you allow the evidence to accumulate. You look across time, but one number is not going to be the basis for an entire decision. Michael?
Yeah, just a point of clarity is another way to think of this Jensen alpha is that it's really showing you by how much your beta was off.
Well, they're all tied together, right? The R squared basically is, it's because each coefficient is tied to every other. So when you get noise, it's not just that your regression is not predicting, it's also that your beta is, that's why we put those standard errors in brackets. Your beta could be off, but if your beta is off, your alpha is off, they're all tied together at the hip because noise permeates everything in the regression. Dan?
Do we normally think of correlation as the multiple R, the R squared? Because when I did my regression, I had
correlation is just the square root of the R squared.
Yeah, I have a multiple R of 60% and an R square of 46%.
Yeah,
so that's like
just take the 0.6 and square it. You should get the. Yeah. That's basically what it is. Yeah. So let's talk about the beta. Oh, Sam.
Yeah, my question was just going to be, given kind of the distribution of returns, historically, a large part of the gains have come from a few stocks, over time. How does that square with the idea of there, not being a momentum factor that's present over time?
When you say large, so are you saying the Jensen's alpha for the market comes from only the 10% of the stocks that do really well?
Yeah, I'm saying, like, if you look back, over a long period of time.
That is not true, though, because you compute Jensen's alpha, it's less than 50% because of the skewness in the distribution. Because your upside, your downside, what's your worst Jensen's alpha can get? Can't go below minus 100%. On the upside, you can get the Teslas plus 4, so it's skewed. So basically, if I compute the average, you're going to get the skewing, which effectively means that less than 50% of stocks have positive Jensen's alpha. It's closer to 40%, but it's not 10%. It's true that the big high-profile 5 or 10 companies can often get into the news, and these are the companies bearing the market up. but it's not that concentrated. I think there are a lot of people, use anecdotal evidence on the FANG stocks and draw conclusions about them that are not true. In fact, it's always been the case in the S&P 500 that the top 10 or 20 stocks account for a big chunk of the gains, but it's a moving target. So I think that doesn't change the parameters. It just means that for most stocks, Jensen's alpha will be a tiny number. It'll be 1%, 3%, 5%. For the stocks that are real winners, the 10 baggers, it can be 900% or 600%. And if you can latch onto those stocks before the 900% happens, of course, you're going to make a lot of money.
Thanks.
So let's talk about betas. Okay? The regression beta is 1.25. But I also, in terms of truth in advertising, put the standard error 0.10 on that beta. Michael, because you raised the issue of the beta could be wrong. Can you tell me how wrong my beta could be? What's the range on my beta from this regression with 67% confidence? What's the significance of 67%? Do you remember? In statistics, it is one standard error, right? So my regression beta is 1.25. My standard error is 0.10. With 67% confidence, my true beta can be anywhere from 1.15 to 1.35, plus or minus 2 on standard error. With 95% confidence, that's 2 standard errors, my true beta can be anywhere from 1.05 to 1.45. See what I'm saying? People treat betas as facts. Betas are estimates. It's not that the service is doing a bad job. It's running a regression. Regressions give you beta estimates with ranges, and we somehow forget those ranges. Now, part of you is saying it's 0.10 standard error. Is that small? Is that large? I'll give you a graph that should scare you if you've been using any kind of service or regression beta. This is a graph of the standard errors in beta estimates. This is not the beta estimates, it's the standard error. The median standard error for a beta estimate in the US is 0.25. Think about that. The next time you hear somebody say the beta for Coca-Cola is 1.12, what are they really saying, given the standard error? The true beta for Coca-Cola can be anywhere from 0.62 to 1.62. Regression betas are noisy. And when I say noisy, this is what I'm talking about. There's a range around the beta. And the range around the beta can make it pretty much useless in some cases. I don't know how many of you are doing young companies. If you're doing an Airbnb or you're doing, if they've made enough, clearly young companies to start making, but if you have a young company making money of 2 years of data, you run a regression beta, do not be surprised to see a standard error of 0.50 or 0.60. A standard error, which means your true beta could be any number. Which brings me to the final piece of output. So the Intercept told me Disney was a good investment. The beta told me something about Disney's risk. The R squared tells me how much of Disney's risk comes from the market. The R squared is 73%. So what? Remember the big deal we made about you can diversify away some risk, company-specific risk. In the case of Disney, 27% of the risk will be gone if you spread your bets across many investments. The remaining 73% will stay. So the R squared tells me the percentage of the risk in my stock that comes from the market. Now, Disney had a 73% R squared. That's a high number, but the R squared for US companies, in fact, global companies, is about twice what it was before 2008. The median R squared for US companies used to be about 30%. It's now closer to 55%. Why do you think that is? What does that tell you as an, because I think there's a profound lesson embedded in that shift. But why do you think it's happened that the R squared for stocks has gone from 30% to 55%? John, what do you think is going on? John Seaman.
I'd say it's probably correlated directly with the increase in index or ETF investing.
That could be. It could also be that macro risks are a much bigger part of every stock story now than they were 13 years ago, right? I mean, think about it. Post 2008, whether you like it or not, there's no place to hide. There's a crisis every year. It affects your stock. So some of it could be the kinds of investors that you're more passive investing. Some of it is macro. But whatever the reason, the R squareds have gone up. And there is a reason why value investors are having a much more difficult time now than they did 30 years ago. I remember when I first started listening to value investors and value investing, one of the things they would say is, don't worry about the macro economy. Don't worry about the market. Just focus on your company, do your research. And if you do your research well, it's all going to be okay. In fact, you can hold only 3 companies. Just do your research. That is horrifically bad advice now. Because you can do all the research in the world, but how the heck do you foresee that a COVID is going to shut down the global economy for 9 months? And that you bought the very best restaurant in the world, and every single part of that restaurant was shut down during the year. I sent you the link to Charlie Munger's interview last week, and I love listening to Charlie. The guy has no filters left. And if you've ever watched this TV show Golden Girls, one of the characters in that show has a problem. So she just says whatever's on her mind. Charlie Munger's like that. He says whatever's on his mind. But he's 97 years old. He's a very, very sprightly 97-year-old. But he sometimes says things and you say, hey, do you realize, Charlie, that this isn't, forget about the 1960s. It's not the 1990s. Because one of the things he said last week, and I sent you the link to this, he said, hey, that you just need to own 2 or 3 stocks. Thank you, Charlie. I hope your 2 or 3 stocks are Kraft Heinz, McDonald's. I mean, can you imagine buying 3 stocks no matter how much research? But that is at the core of old-time value investing, is if you do all your research, who cares? The macro stuff will just average out. We don't live in that world. One reason why I think we all need to diversify more than 13 years ago is precisely because of this factor. Is you cannot do research in individual companies and expect this big payoff, at least as big a payoff as you did 13 years ago, because of this market-wide factor. One final point about R squared. No, let's take the Charlie Munger advice, because there are people who are going to listen to it. And let's say one of the people who listens to it is your uncle. You know the eccentric uncle that you're always put next to at Thanksgiving, who has all these ideas about how to invest, and he tells you specific terms why. So let's assume that you're sitting there, but you're a diversified investor. So basically, you just hold more stocks simply because, whether you listen to me or whether you've used your own common sense, you got to that position. If you're a diversified investor trying to pick between 2 stocks, they have the same beta, but one has a high R squared. Let's say it's Disney, and the other is a low R squared. Let's call it Amgen. Which one, if either, would you pick as a better investment? As a diversified investor, do you care about R squared? What happens if you're a diversified investor to what's not R squared in a stock? It goes away, right? So if you're a diversified investor, I could give you a stock with a 7% R squared. I could give you Airbnb and say, you know what, it's low R squared, but you say, I don't care, I have 50 stocks, I have a low R squared, things are going to average out, I'm okay with it. So if you're diversified, you can be casual about R squared because it gets cleaned up in your portfolio. But your eccentric uncle next to you says, look, I buy only 3 stocks. Should he buy high R squared stocks or low R squared stocks? Tom Valente, what do you think? Somebody wants to be not diversified. Would you suggest he buy Disney or Amgen?
So the investor wants to be as not diversified as possible?
They're going to buy only 3 stocks. And they say, look, you've gone to business school, just tell me which 3 stocks to pick. Trust me, you're going to be asked for this kind of advice all the time. My advice generally is don't give investment advice. It never ends well, no matter what the advice is, even if it's good advice. But let's say you're a little drunk, it's Thanksgiving, and you decide to give advice. So would you suggest he buy 3 high R squared stocks or 3 low R squared stocks?
I think I would say 3 low R squared stocks in this case.
And so you'll end up with a portfolio of 3. Let's let this through. So the risk that's not captured in R squared is usually eliminated through diversifying, but he's not diversified. So let's put 3 stocks together. Let's put Moderna in his portfolio. We heard a lot of good stuff on it. A lot of the risk is company specific. The second company could be Palantir, right? Stock, which is a data model that feeds into governments. And the third stock is Airbnb. Yeah. So
Great.
he takes your advice, he buys these 3 stocks. What's the danger he's exposed to over the next year?
So I think that the market could have a really good year, but those individual stocks are uncorrelated to the market, and
They could do crazy things. His entire portfolio could be up 80% or down 60%, right? Because he's exposed to risk now that he's not hedging, that he's not diversifying away. So
that was his goal, though, right? To be undiversified.
If his goal is actually to make the 80%, but never be exposed to the 60%, right? So if his goal is just to make the most money, you're right. He should, but if his goal is to have a portfolio where he's not going to be in poverty a year from now, bad things happen, he should buy a high R squared stock. So this, I think, is at the core of what's happening in investing right now that scares me. A lot of investors are not diversified, where they listen. And the 2 or 3 stocks they own tend to be stocks like Moderna, which means they're going to do really well or really badly, and they're investing money that they can't afford to do really badly on. It's one thing when you're wealthy, and this is discretionary wealth. It's another thing if this is your pension fund. So if you're diversified, I don't even look at R squareds of companies. I have 50 stocks in my portfolio. What does it matter to me whether the R squared is 10 or 50%? But if somebody who wants to hold only 5 stocks asks me, should I buy a stock with a higher or low R squared? First, I'd ask them what's their end game in the portfolio. If it is to make the most money, I'd say just put it on one stock, see what happens. Maybe Tesla will continue to run, just put it all in Tesla. Or if they want to have a portfolio that will actually preserve its wealth, then I've got to push them towards high R squared stocks because they cannot afford to be in low R squared stocks if they're not diversified. So when I first started teaching this class, everybody in the class had to run the regression themselves. They did what Dan did. Dan actually ran the regression with his stock over the last week. Now, as I said, it's not complicated. It's a little tedious. You got to download the data, put an Excel spreadsheet, run the regression yourself. 20 years ago, we got our first Bloomberg terminal at Stern. There's one terminal for the entire building. And it was a godsend, at least for everybody in the class, because I said, look, I'm not going to make you run the regression. Just find a Bloomberg terminal and print off the beta page for your stock. So I printed off the beta page for Disney, using exactly the same parameters that I used in my Excel spreadsheet. You know what I wanted to check, right? If Bloomberg uses exactly the same parameters that I am, are they delivering the same beta? Because I know what I did was what was supposed to be done. I wanted to make sure that Bloomberg was doing what it was supposed to do. And that's actually a good test to run. Before you trust any Bloomberg number, make sure they're doing what they're supposed to do. So this is what the beta page looked like. So let me review. I ran a 5-year monthly regression of Disney against the S&P 500. And if you remember, I got an intercept of 0.71%, a slope of 1.25, and an R squared of 73%. So let's see if Bloomberg delivers the same data, because I took Bloomberg, took the same 5 years, monthly returns against the S&P 500. Let's start with the raw beta. Pretty close, right? 1.247, rounded up 1.25. I'm feeling pretty good right now. The betas match up. I'll come to the adjusted beta in a moment, but below the adjusted beta, it says alpha. That's kind of a misnomer. It's really the intercept, and it says 0.599. Bloomberg is incredibly sloppy about percentages and decimals. That is actually 0.599% or 0.60%. Do you remember what I got? 0.71%. And when this first happened, when I first started, I noticed this on company after company. The intercept I was getting was off by a little bit from the intercept that Bloomberg was getting. You think, what's going on here? Turns out that Bloomberg, when they run their beta regressions, use only price changes for returns. So what are they missing? No. Julie, when we did returns, what do we have in addition to price changes? When we did the returns on Disney and the index, what did we bring in addition to price changes?
Dividends.
We got dividends. They skip it. You know why they do it? Because the computer runs the betas. And it's messy bringing in dividends, so they took the easy way out. And their defense is, why are you making such a big deal out of it? The beta is roughly the same, 1.25. So we're trying to, you know when it's going to make a difference? With Disney, it doesn't, because dividends are a small part of the returns. But if I ran a regression for a REIT, a real estate investment trust on Bloomberg, I wouldn't trust that number further than I could throw it. What's different about a REIT, Nate Smith? Why are REITs tricky?
Presumably because they could pay high dividends.
In fact, they have to pay high dividends. They're required to pay out 95% of their earnings as dividends. So the dividend yield is most of your return. And if I don't count that as your return, then obviously the beta is going to be all over the place. Now, does this mean that if you're doing a REIT, you have to run your own regression? I'm going to let you use a Bloomberg, because ultimately we're going to throw this page out anyway. But you can see that that's a reason. Let's check out the rest. The R squared was 73%. So my beta and R squared match up. My intercept is slightly off. I can live with this page. Which leaves me with one final number for item from this page that I haven't talked about, which is the adjusted beta. Sounds deep, right? Adjusted. Saying, what is it adjusted for? Not much. I'll tell you how Bloomberg computes the adjusted beta for every single company that it tracks. It tracks like 40,000 companies. It takes a raw beta and multiplies by 0.67. Hang in there with me. Raw beta times 2/3 is 0.67 plus 1/3 times 1. You think, what? If your raw beta is 1.8, your adjusted beta is going to become 1.53. Track me as I go along. 1.8 will become 1.53. 1.5 will become 1.33. 1.2 will become 1.13. 0.6 will become 0.73. Do you see what they're doing? They're taking the regression betas and moving them towards 1. What's so magical about 1? It's the average beta across all. They're trying to be helpful. They're saying, look, your company is a high beta. Over time, that beta is probably going to move towards a market average. We'll help you out. To which your response is, please stop helping. Because these weights must be magic weights, right? 0.67 and 0.33 to work for every company in the face of the earth. So 20 years ago or maybe 18 years ago, when I started looking at these adjusted betas, I want to know where the 0.67 and 0.33 came from. So I called Bloomberg. Not the company, not the mayor, but the company. This is a little tricky in New York for a while, mayor and company having the same name. I should probably have called the mayor first. And they put me in touch with a beta calculation guy at Bloomberg. There's actually a guy at Bloomberg whose life it is to maintain this page. Can you imagine how exciting his life must be? He goes to a cocktail party and says, I am the beta guy at Bloomberg. Dozens of people gather around for anecdotes. Not really. The guy was pathetically grateful to get a call from the outside world. I don't know what they do to him. Maybe keep him locked up in a basement room, feed him through a hole in the wall. So I'm so glad you called. I have all day to answer your questions. And I have all day to ask him the questions. But I was afraid if I hung up the phone too soon, he might do something rash. So after what I thought was a polite period of conversation, I hit him with a question, why 0.67 and 0.33? He said, 2 minutes of silence. I can hear papers being rustled, terminals being turned off and on. And finally comes back on and says, I don't know, it was here when I got here. I said, what? He said, I was hired 2 years ago. It was already there. Don't blame me. I'm not blaming you. I just want to know where the numbers come from. He said, I don't know. Here when I got here. You know how often that is going to be the answer to questions you ask when you start working? Why do we keep using a 6% equity risk premium? I don't know. It's here when I got here. When did he get here? 1979. You've never asked? No, I just do what I'm asked to do. I don't look under rocks. There's absolutely no information in an adjusted beta other than telling you which direction one is. And none of us has any trouble figuring that out on our own. So when you see analysts use adjusted betas, I just ask them a single question. What is it adjusted for? Because the honest answer is nothing. It just moved towards one. So when you do your beta page, just draw a line through the adjusted beta. It's a completely useless number other than telling you which direction one is. So now let's talk about pulling, because let's not lose sight of where we started the process. We needed a minimum acceptable hurdle rate. Remember, that's what started this entire 150-page foray. Let's talk about how we can use the beta from the regression to get that expected return. In November of 2013, if you ask me what the expected return on Disney was, I would start with the risk-free rate. In what currency? I did everything in US dollars. It was a choice. My risk-free rate was in US dollars. My 10-year T-bond rate was 2.75%. So that's my starting point. The regression beta was 1.25. It came from the... And my equity risk premium, if you remember, for Disney, was a weighted average of where they did business was 5.76%. Risk-free rate plus beta times risk premium gives me 9.95%. That's a CAPM in play with every number, and we've talked about risk-free rates, betas, and risk premiums coming into play. Now let's dig a little deeper, because we do this in every finance class. Risk-free rate plus beta times risk premium. We do it ad nauseum. We lose sight of what we're trying to do. Let's think about what this tells us as potential investors. Let's say you're potential investors in Disney in November of 2013. I've done the number crunching. I've come up with 9.95%. I'm going to make a couple of statements about this 9.95%, and you can tell me whether these statements are fair or not. So you ready? Potential investors, November of 2013, T-bond rate is 2.75%, beta is 1.25, risk premium is 5.76%. I've come up with 9.95% as my return. That is the return you can expect to make in the long term on Disney if the stock is correctly priced and if the CAPM is the right model for risk. How many qualifiers did I add in that statement? Let's look through. You can expect it. No guarantees, long term. Don't come to me next year if the stock is correctly priced. If it's not, all bets are off, and the CAPM. 4 qualifiers in one sentence. You know what? I'm an extremely lazy person. If I'm adding that many qualifiers, it's because the statement is true. And that is technically right. If you lived in a market where everything was priced right and the CAPM was the right model for risk, this is your expected return on Disney. But I've never been happy with that description because it makes it so passive. Because I want a higher return in that market, what do I need to do? Buy a higher beta stock. So here's my second description, and this to me is more appealing. 9.95% is the return I need to make on Disney to break even on that stock given its risk. Let me repeat that again. Suddenly I've become very needy. Remember, the risk-free rate is 2.75%. Why aren't you settling for 2.75%? Because I'm taking risk. How much risk? The beta captures that. And given the price of risk in the market, 9.95% is the return I need to make on Disney. So if you are a potential investor in November of 2013, I've given you what you need to make. But you're still interested in the bottom line. Should I buy Disney now? And to do that, what do you have to do? You have to go and do your own analysis of Disney, assess their movies, their business, their future prospects. And after all of your research, if you conclude you can make 12.5% a year on Disney based on your research, remember, you need to make only 9.95%. What does it make Disney to you, a buy or a sell? The fact that you can make 12.5% and you need to make only 9.95%. To me, that's a buy. You're making more than you need to make. That is at the basis of active investing, right? Active investing, you need a hurdle to beat. That's why when people, picking on value investors again, You'd be surprised how many value investors say, look, I don't use the CAPM. I say, okay, what do you use instead? So we don't use anything at all. So how do you then decide what's cheap or what's expensive? It's just your gut that's speaking up there. The CAPM doesn't pick stocks for you. It doesn't say what's good or bad. It just says, this is what you need to make. And then you have to do your own research to conclude. That's what my valuation class is all about, is coming up with that 12.5% in a better way. Because that's what research and analysis is to try to deliver that return. So as potential investors in Disney, you need to make 9.95%. Let me pause. Any questions on that notion of how the CAPM gives you what you need to make? So it doesn't tell you what to buy or sell. It's just a risk and return model. It just says, this is what you need to make. Go pick stocks that beat that, and you in a sense pick good stocks. So now let's turn this number around. Let's say I'm the CFO of Disney. Your potential investors in Disney. What's the return you need to make? 9.95%, right? So if I'm a good CFO and I am trying to deliver on good projects for you, movies to make, new theme parks to take, collectively, what kind of return would I need to deliver on the investment you make in my company? What do I need to earn on my projects as a return in equity for it to be a good project? You need to make 9.95%. I need to deliver at least 9.95%, right? We think people often use the word cost of equity. Say, what exactly is the cost of equity? The cost of equity is what you as equity investors in my company need to make. And at least collectively across the company, I need to try to deliver more than 9.95%. So when I look at projects, and they're making a 3% return in equity, I'm going to hold back and say, you know what, maybe that's not the project for me to take because my investors need to make 9.95%. But 15 years ago, I was sitting across the table, the CFO of a very large Asian company. So out of the blue, middle of dinner, he looks at me and says, what do you think my cost of equity is? I'm in the dessert round of dinner. I'm not particularly feeling like talking about cost of equity, but I knew this guy's company pretty well. And I said, I said, what currency? And he said, oh, in rupees. And I said, I think it's about 15%. I had a sense of what the risk-free rate was. And he said, no, it's not. To which my response is, if you knew what it was, why the heck are you asking me in the middle of dinner? But I wanted to play along. I said, no, if it's not, what do you think it is? He said, it's about 2%. I said, really? It's that low? And he gave me the reason for the number. And I'll give you the reason, and you tell me what he's missing. He said, well, that's what our dividend yield is. That's what we pay out as a dividend yield. So that's our cost of equity. So William Clements, what is he missing? What is the CFO's just looking at the dividend yield as a cost of equity? What is that CFO missing when he's thinking about his cost of equity? You're muted still.
Yeah, I'm talking to myself. I'm not sure.
Okay. Anybody want to try? So if you're a CFO of a company, you're paying out, in fact, in Google, what's your cost of equity? We define it to be the dividend yield. What's Google's cost of equity? Google pays no dividend, so its cost of equity is 0, right? That can't be right. So when I buy shares in Google, why am I buying those shares? For charity? No, I want my stock price to go up. You know what the cost of equity includes? It includes a dividend yield and an expected price appreciation. I understand the expected price appreciation is uncertain. The cost of equity of 9.95% for Disney includes both a dividend yield and a price appreciation. You can't just count the dividend yield and say that's your cost of equity, because then where will investors get that extra oomph that led them to invest in stocks in the first place? So while we're still at dinner, I explained to the guy that, this price appreciation component is missing in his 2%. And then he asked me a question that completely floored me, but it shouldn't have. He said, so what if I don't deliver the price appreciation? You see what he was asking? When I borrow money at a 10% interest rate and I don't pay the 10%, I go bankrupt. But when I issue shares and investors expect me to make 15%, but I deliver only 2%, what can they do? As stockholders, you can't go to court and say, he told me, that this is a risky business. We built in a 15%. It's not a contractual claim you can enforce. You can't go bankrupt. Now, if it's for a CFO who says, what if I don't deliver the price appreciation? Would you have a good response? What do you lose as a company if you consistently keep taking projects with 2% returns when your cost of equity is 15%? What's going to happen to that company's stock price? It's going to drop and drop and drop because I have nothing else to adjust the value for, right? So I said, your stock price will drop. He said, so what? No, seriously, he said, so what? We're not planning to raise any equity. So I tried to hit him with a corporate governance argument, which is if your stock price drops enough, your stockholders will get really pissed off at you and they'll fire you. And he started laughing. He said, do you see what my last name is? You see what the name of the company is? Notice they match. What he was trying to say in an indirect way is, we control the company. There is nothing that shareholders can do to us. So we're going to treat equity as if it's free capital and do whatever we want with it. It's not an abstraction. Companies often seem to treat equity as, hey, what difference does it make what we take? We already have the equity capital. We are protected from any kind of backlash. And that's why I started this class with corporate governance, because if you don't think stockholders matter, your cost of equity is not going to be this number because you really don't care what stockholders can do to you. For this to be a cost of equity, you need some semblance of governance, some semblance of fear that your stockholders, if they're not happy, will essentially remove you.
And how's that company doing today?
Not very well, because they kept taking bad projects. They're now trying to extract themselves from bad businesses. And you know why they got into bad businesses? Is you keep demanding a 2% return, everything's going to look good to you. You're going to buy airlines. Oh, they look good, 2.5% return. That beats the dividend yield. It's almost predestined that you're going to get there, right? Japanese companies in the late 80s treated equity as free capital, took every investment under the sun because they earned 2 or 3%, and ended up spending decades trying to dig themselves out of those investments. So what I'd like you to do is take your beta page for your company. Take your beta page for your company. Leave it at a 2-year weekly. You don't even have to change it. Take it through what I did for Disney, and I'll send a little guide to how to read your beta page. This is the best way for it to stick, is rather than go back and review my Disney once, but then take your stock and take it through the process. Good news is this is something you need to do on your project anyway. It'll get that part out, and you can at least get a sense of how a regression beta page can give you a picture of your company. So let's say you've run your regression beta and you've come up with a really high beta for your stock. Let's play a game. Let's assume that I am the CFO of a very risky software company. How risky? My beta is 3.0. I'm 3 times more risky than the average stock in the market. And if I have a beta of 3.0, you know what my cost of equity is going to come up with. A beta of 3.0, I'm going to end up with a cost of equity, let's say 20%. So you're my consultant. You're McKinsey or Bain or BCG or take any consulting firm, KPMG. You come to me and you tell me my cost of equity is 20%. First, as a CFO, do I want a high cost of equity or a low cost of equity? Just from a practical perspective, what makes my life easier? Jimmy Kepner, do I want a high cost of equity or a low cost of equity?
I would say you'd probably want a lower cost of equity.
And tell me why. I agree with you entirely.
So I would say a lower cost of equity because you would have a lower hurdle rate for projects.
And I could take more projects. So when he told me 20%, this is really high. So then I ask you a question, Jimmy. I'm going to keep you on the spot. Say, is there something I can do? Because you tell me why my cost of equity is high. It's high because my beta is high, right? So I ask you, is there something I can do to bring my beta down?
So, I mean, if you're to bring your beta down, could you have your returns be more similar to the market returns? Is there a way
But that's
to
the output,
influence
right?
that?
What can I do? Because clearly my returns now are moving with the market, but they're much more volatile. What is it that's making them more volatile? One is I'm in a risky business, right? I'm in a risky business. It's not really my fault. It's not because I'm running the company badly. So if I can make my business somehow a little less risky, you're saying as a software company, how the heck are you going to do it? If you notice that most of your software now is shifting from the old model where you bought software to subscription models.
So is this
For instance,
like...
now I have Adobe and Microsoft. It used to be at one point in time, I'd buy the software whenever a new upgrade came out, but I'd wait if I wasn't feeling like I needed it. I'm now on Adobe Creative Cloud. They charge me $30 a month. And I'm on Office 365. They charge me $100 a year. The advantage of a subscription model is it smooths out your revenue. So it's a way of making. So the first thing I can try to do is try to create a business model that is a little more stable. The old software companies, the other way they tried to do this, were having a consulting arm, but the consulting income was more predictable. So the first is I can try to make my business more stable. Anything else I can do? Morgan Schultz, do you think any ideas on how I can make myself a less risky company?
You could invest capital in more predictable.
Yeah, I could put my money into a nice utility, right? Or I can put my money in cash. That's the most predictable of all assets. I can build up my cash balance, but there's a trade-off there, which is I'll make my beta lower, but I'll also make my returns lower. So, I mean, it's not a free lunch, but no, I could do that. It's a third thing to consider. Anybody have an idea on what it is before I? We have a lot of fixed costs as a company. It makes you a riskier company. Do you see why? Because if you have a lot of fixed costs, in good times you make a lot of money, in bad times you lose a lot of money. If I can somehow change my cost structure to make it more variable, I could make my betas lower. Can you think of anything that companies do that make fixed costs into variable costs? Been a big trend. In fact, over the last 30 years, a lot of US companies have done this.
Outsourcing.
Outsourcing. What does outsourcing do? It takes a cost that used to be a fixed cost and makes it into a variable cost. I mean, I'm not saying outsourcing is good, but I'm saying from the perspective of cost structure, it makes your cost structure more flexible. You can change your business. You can try to go into safer businesses. You can reduce your fixed costs. And there's actually a fourth component. There's one fixed cost you create that's self-inflicted. You know what I'm talking about? When you borrow money, you create a fixed cost you did not have until you borrowed the money, which is interest expenses. So if you have any debt, pay it off. So if I asked you, can I bring my beta down? The answer is yes, you can. But then if you ask me, should I bring my beta down? My answer is more nuanced because as Morgan pointed out, I can bring my beta down by liquidating my entire company and making it into a money market fund. My beta will go to a zero, but what kind of company would that be? I don't think companies should be focused on trying to bring their beta down, to be quite honest. They're focused in the wrong place. They should be focused on trying to deliver the highest returns they can, given what their beta is. It's a danger and opportunity thing. Your best returns are often in the riskiest businesses. And as long as you deliver a return that exceeds your hurdle rate, I'm going to reward you. Let me tie up the loose ends on my other companies. I won't go through them, but I did the same beta page that I did for Disney for my other public companies. For Tata Motors, I stuck with the Bloomberg default. The Bloomberg default runs the regression against the local index, the Sensex. And the regression has the same kind of output, right? I get the slope, I get the range. So basically with 67% confidence, I can tell you what the beta is. 1.83 is the regression beta. The R squared is 69%, which means 69% of the risk in Tata Motors comes from the market. The Jensen's alpha for Tata Motors was astoundingly high. It was almost 35.42%. You say, what did Tata Motors do between 2008 and 2013 that made it a great investment? Those of you who are from India, Tata Cars have actually had a pretty tough decade. They've lost market share to pretty much everybody around them. But Tata Motors did something in 2009 that dramatically changed them as a company, which is buying Jaguar Land Rover at a discount price. It's not that they bought the company, but they bought it at a bargain basement price from Ford. You know why Ford got rid of it at a bargain basement price? Because it was 2009. They were worried about the economy, whether they'd come back. That investment is what delivered this 35.42% return that they got. So when you look at your stock and you see an astoundingly high Jensen's alpha, dig a little deeper. What is it that happened during this period that gave them the alpha that they did? Because the Tata Motors, that's the answer. And finally, if I were to use the beta to get a cost of equity for Tata Motors in rupees, I start with the risk-free rate in rupees. Remember how we got that? I start with the government bond rate, netted out the default spread, 6.57%. I move on to the beta for Tata Motors. From the regression, it's 1.83. And the equity risk premium I use for Tata Motors is not the equity risk premium for India, but a weighted average of where Tata Motors does business, which is all over the world. Remember, the second biggest market is China. My expected return in rupee terms is 19.73%. Already your first reaction, that looks really high. Remember, that's in rupees. We have to be careful when we talk about hurdle rates to be clear about what currency you're in. In this case, the rupee cost of equity is 19.73%. I know we're getting towards the end here, but one of my problems, I've already talked about one problem with regression beta is that standard error and the noise. Here's a second problem. It's easy to play games with regression betas. And if you've got any time on the Bloomberg, I gave you ways of playing the games, right? Change the index, change the starting point and the ending point. For Vale, for instance, I could run the regression for Vale against a Bovespa. Or I could run a regression of Vale's ADR, which are US listings of Vale. They're traded in dollar terms against the S&P 500. I get very different betas from the two regressions. You're saying, which one should I use? My advice is neither, because you gave me 4 more chances. I could run 4 more indices and give you very different betas. But you will see analysts play this game where they will keep running regressions till they get the beta they wanted to see before they started even running the regressions. The gameplay. And in fact, to show you how much the game playing can matter, with both Deutsche and Baidu, I actually reran the regressions using different indices. I ran the beta regression for Deutsche against the DAX, which is the German index, but then I ran it against the Euro index, very different betas. For Baidu, I ran it against the S&P 500, the NASDAQ. What I'm trying to say is, if somebody gives you a beta page, check the index. Then ask them, how many indices did you try before you got this beta page? Because you give me enough time and access to a beta Bloomberg terminal, I can deliver exactly the beta you want because I have so many parameters under my control. So that's all I wanted to say about regression beta. So what I'd like you to do before Wednesday's class is get your Bloomberg beta page for your company, take it through the process I did with Disney. Think of this as preparation both for your quiz as well as getting a part of the project done. You can put it away. And on Wednesday, we're going to dig a little deeper. And I'm going to argue that betas don't come from regressions, because that's good, because I hate regressions. I'm going to talk about the choices companies make. And you've already started to see at least some twilight on that, because when we talked about what can I do to bring my beta down, I didn't say go rerun the regression. I said, change your business model, change your fixed costs, change your leverage. We're going to focus on those determinants and see why they play out as the betas you see for your company. So that's it, and I will see you on Wednesday. As I said, the past quizzes are there. Now those quizzes go back almost 30 years. So there's a lot of quizzes. So my suggestion is start with the most recent quizzes and work backwards, because the material is kind of morphed over time. It's still got commonalities that you can still try the 1998 quiz and have some value out of it, but you get more value out of the 2018 quiz. But the one caveat is this quiz will not be open-ended like prior quizzes, because with doing it online and it's much more messy. So I have some good news and bad news. The good news is this quiz will be a mix of multiple choice and boxed answers. If you get the answer, you're done. So you won't have this elaborate, the questions will have to be a little simpler and more direct because of that. That's the good news. The bad news is it's all or nothing, right? There's no partial credit in a multiple choice. So to alleviate that, I've kind of spread the points out across the question. So no single question is a big enough chunk of the quiz that if you screw up with a silly math error, it's going to drag you down enough that it demolishes your quiz score. So now be ready for smaller questions. The type of questions you run into will be exactly like past quizzes, but it'll be maybe half of that question rather than the multiple parts you see on past quizzes. That's it, and I will see you on Wednesday. Take care.
Thank you.
Thank you.
Professor,
yes.
Quick question. I just did a quick Jensen's alpha for my company and negative 99%. And I know that sounds crazy. I'm just trying to figure out.
Well, maybe I think you might have a decimal messed up. So remember, you're getting it from Bloomberg, the Intercept?
Yes, from Bloomberg.
What's your Intercept?
Negative 20.7%.
It's what? So read me the actual number from Bloomberg.
Negative 0.207.
That's why I said Bloomberg is very sloppy about percentage. That's not negative 20.7%. It's negative 0.207%.
Oh, okay.
So it's not your fault. I would have done exactly the same thing if I didn't know better, but Bloomberg is incredibly sloppy. It's minus 0.207%. That will make a big difference.
Yeah.
So that'll make your alpha more. It'll still will be negative, but won't be minus 99%.
Okay, awesome. Appreciate it. Thank you.
Welcome.
Professor, I want to ask,
yes.
When you were checking the market, comparing the betas for the company stock in the markets with the market, I just want to know if a company is diversified across geographies, what is a good, in benchmark market? Is it like a weighted average?
It's not a question of what the company is divided. This is not the equity risk premium, so it's not even relevant there. The question is who your marginal investor is. Right, a marginal investor is a global investor. Even if you're a company with all of your revenues in India, when I run the regression, I've got to run it against a global index. So this is less about what you do as a company and more about what investors in your company are investing across, right? So if your investors are all domestic Indian investors and all they can invest in is Indian stocks, okay, if you're a multinational Indian company, the beta that those investors will focus on will be the beta against the Sensex.
Okay, because their returns would be as according to the Sensex.
Because this is a measure of risk. It's got nothing to do with returns. It's a measure of how much risk will it add to my portfolio. If your portfolio is all Indian stocks, then you want to measure risk relative to those.
Okay, makes sense.
Okay.
Thank you.